Good morning, class. My name is Martin Forster, and today I would like to talk about building societies and why have they declined in numbers and what does the future hold for them. The decline and why it happened, pre-deregulation. In the year 1975, building societies had peaked at 178 societies in Australia. They first appeared in Australia in the late 1840s. They were relatively small regional institutions. From the years 1950 to 1970, building societies grew strongly, largely because they were subject to fewer regulations than banks. Banks were required to hold a minimum level of capital of 50 million, while building societies only required holding a minimum of 10 million. Australia had also seen a high demand in home ownership, increasing living standards with the acceptance of high-wage mortgage lending, and a banking sector that was slow to respond had brought on this rapid expansion of the amount of building societies. During pre-deregulation, first the controls were weakening the position of banks and their ability to respond to customer needs. Banks were rapidly losing market share in the financial system. By the early 1980s, their shares had fallen to 40%, compared with 70% in the early 1950s. Second, the controls were becoming ineffective as new, unregulated intermediaries sprung up to provide finance. Third, the financial system was quite inefficient, with wide interest spreads, little innovation, and many credit-worthy potential borrowers unable to get access to credit. Deregulation. Deregulation started in 1973 until 13 years later virtually all controls on banks had been removed. Foreign banks had been allowed to enter the market and the exchange rate had been floated. As a result of deregulation, by 1985, building societies had reduced to approximately 70, as there had also been an economic slowdown along with mergers and takeovers. The sector continued to contract, and at the end of 2005 there were only 14 building societies. With this, capital adequacy has trended upward, while the weaker have liquidated or consolidated with healthy ones. Interest rate spreads had widened with low interest rates. Loan losses have declined to nominal levels. Overall, the earnings have improved through mergers, conversions, and acquisitions, and of course, the disposition of failed institutions. The GFC effect. Looking at the GFC, Australian authorised deposit-taking institutions were well regulated, and according to the risk appetite of ADIs was far less excessive. Australia's relatively small financial system had limited participants helps ensure that each ADI runs prudently and transparently given the increased scrutiny on it. Subprime-backed securities didn't make it to our shores, but only in amounts that did not cause systematic damage. Australian ADIs and mortgage brokers did not reduce or remove lending policies to the point where people with no jobs, income, or assets could obtain a loan, as was common practice in the US. When credit markets became illiquid for ADIs to access funding, the Australian government assisted by instituting a 3-year, $1 million capped bank deposit guarantee in November 2008, and with deposits over 1 million eligible for the guarantee subject to payment of a fee. One of the key side effects of the GFC within Australia's financial industry was that it effectively killed competition in the sector. The Big Four banks dramatically and significantly increased their market share as consumers looked for safety and security, and saw size as a key measure of this. In the wake of the GFC, the Big Four banks held more than 85% of the home lending market and more than 75% of deposits. In the period following the GFC, competition in the finance industry began to emerge as a key issue, with consumers reacting adversely to decisions being made by the big banks. The most common objection related to the behaviour of many banks is increasing home loan interest rates above the rises set by the Reserve Bank of Australia. Future outlook. The federal government again stepped in and flagged its intention to introduce a reform package to promote the greater competition in the sector. The creation of a fifth pillar made up of Australia's credit unions and building societies, known as CUBs. It is argued that they play an important role in offering an alternative to the larger financial institutions, with some providing services in regional areas not serviced by the larger institutions. Why haven't the building societies stepped forward before now to take on this mantle? This can largely be attributed to an inability to access funding at a price similar to the major four banks, affecting their ability to compete on price, and the public's perception that bigger is better. The perception that building societies aren't as safe as the major banks and that they are not regulated in the same way is simply not the case. Improved awareness of the prudential system and the introduction of the government protected seal have ensured that all Australian ADIs are monitored with consistent measures. These reforms are essential as consumer confidence in ADIs have not been battered by the GFC, and the Australian public want to know that their ADI is well regulated and the money is safe. They have been able to maintain profitability and growth considering those things that I had mentioned earlier. Thank you for your time.